Congress has made a lot of changes to 401ks that's in effect January 1, 2024. So in this video, I'm gonna go over what the big changes are and then what it means for your retirement savings. And some of you might be thinking, how does this impact my retirement or income plan right now? Or how does this change how much tax I might have to pay in the future? And then also, does this impact me if I'm already retired? Very quickly, when it comes to those who are already retired, there's changes, but it's gonna be happening over time, not in 2024. The main ones just is the increase of the required minimum distribution age. So the RMD age, that's when we're forced to take out of our IRAs and 401ks and pre-tax accounts. So that's gonna be going from 73 up to 75. And in my opinion, this is actually great because when we're thinking about tax efficient withdrawal planning, even those 2 years, anything that gives us more control over when and how much we have to take out of our 401ks or IRAs, that's a good thing. Right? We find with our clients at Streamline Financial that tax-efficient withdrawal planning is one of the things that can add more value and more return to a portfolio than even optimizing the investment plan. That rule, though, like I said, it's not being implemented in 2024. It's going to be happening over the next few years before 2033. So we'll just have to wait and see what Congress does. Now, how about those of you who are not yet retired, but you're close to retirement? There are rules that impact you as well. You've heard of the catch-up contribution. So if you're over 50 in your 401ks, there's this catch-up contribution that you can add to more than everybody else who's under 50. And it's this year, $7,500, which is great. The thing that's changing is for people between 60 and 63, they may be eligible for a special catch-up contribution above and beyond that other one, which is either $10,000 or 150% of what the standard catch-up limit is for that year. So if that doesn't make sense, here's the example. Standard catch-up contribution, say it's 2025 and the catch-up contribution is gonna be $7,500. Well, a person who's 60, 61, 62 would be able to add an extra $11,250 to their 401k. And that's just 7,500 times 1.5. Again, this rule is changing in January 1, 2025. So let's get to the ones that are in January 1, 2024. Number one is we've heard of emergency accounts before, right? But what this new 401k rule does is it's going to allow companies to introduce an emergency savings account. So it's an account where 3% of an employee's paycheck can be set aside, which can then be used for emergencies in the future, which could be nice. You know, as you think about it, it's automatic like a 401k contribution. And it's a little bit more removed than what a regular emergency fund might be at the bank, right? And sometimes when it's out of sight, out of mind, that could be a good idea for building this reserve. Now, the annual contribution limit right now is $2,500 per year, and the employees can adjust the percentage, or they could opt out completely for this one. The next one I thought was great because it's eliminating the 10% penalty that's usually applied when we take money out of the 401k before age 59 and a half, because anytime we can avoid a penalty, gets a thumbs up from me. But for this rule, it says individuals can withdraw up to $1,000 once per year for emergencies without paying that 10% penalty. And that could actually be paid back over the next 3 years if they want to do that. And this one might not be a big deal for you, but it could be useful. And for most of America, right? Most of Americans, it's really a last resort for people who don't have that savings set aside if they had this sort of option to use their 401k without a penalty. Now, the next one also is a nice addition if it's used for the intended purpose. And this is allowing individuals who are facing domestic abuse to withdraw money from their retirement account without needing to prove the abuse. So up to $10,000 or half the account can be withdrawn without a 10% penalty. And that can actually be paid back over 3 years as well. Then the next rule, that change impacts 43 million Americans. Now, if you're not one of them, this might be a good one to share with your kids or your grandkids if they've got federal student loan payments. But before I get into it, let me know, please, if this has been helpful. If it has, click the like button. It really means a lot to know what types of videos you prefer. So starting in January, employers will be able to match the payments that employees make to their student loan. Meaning that if an employee has a student loan payment and they make that payment, the employer has the option to match the amount in that employee's 401k, the retirement account. This is a big deal because this, student loans, that often delays people from saving for their retirement and adding to their 401k because they're trying to pay off their debt like they should be, but that also delays their retirement savings. And they end up missing out on the free employer match, right? The free money. So now they can pay off debt and they can still sock away money for their 401ks, which I thought was pretty good. Now, I'm going over these at a high level, and remember, it's important to research and consult with a financial expert or tax expert before doing anything. And if you're thinking about your retirement more than ever now and wondering if you're doing the right things related to your income plan and your tax reduction plan, watch this video on how to save potentially thousands of dollars just by applying this one strategy. And if you want more videos to make your retirement better, subscribe, and then I'll see you in the next video next week. Take care.